Hello, welcome to our webinar, Essential Lessons in Investing, Asset Allocation, and Planning versus Predicting. We're going to go through a few different things today. We're going to talk a little bit about our company, Aire Advisors, and what we're all about. We're going to talk about the efficient markets hypothesis, risk management and time horizon, and why predictions should not be the primary driver in your investment decisions. We're going to talk about investor behavior, common mistakes and pitfalls and effects on portfolio returns. And then we'll discuss asset allocation, diversification, the importance of correlation, and what really matters in investing. So a little bit about Aire Advisors. The reasons we've started this firm, first and foremost, is because we wanted to create a firm where we are a fee-only advisory firm, meaning we never earn a commission or any sort of pay to make one recommendation over another. We simply charge a simple, transparent annual fee to be the advisor and fiduciary for our clients. Second, we wanted to advise clients on all aspects of their financial lives and all of their investments everywhere, not just what's under our management. So we advise on real estate, we advise on 401k holdings that are held at other companies. We advise on absolutely everything. And third, we really wanted to create content that we felt was relevant and important for investors, such as the seminar you're about to see, and look for upcoming seminars, webinars, articles from us, and hopefully they'll help provide a good education on all aspects of your financial lives. So we're going to start with talking about the efficient markets hypothesis. Just stay with us for this first 2-3 minutes. This is probably the least exciting of everything, but it's the most important thing that we're going to talk about. The efficient markets hypothesis, which is a theory that is taught in virtually every business school worldwide and widely accepted to different levels by some of the top people in the industry, is unfortunately not talked about too much in the media because there's not as much incentive in this message. But what the message says is that the definition of an efficient market is asset prices in an efficient market reflect all relevant, available, and known information, as well as the market's consensus expectations about unknown information. So what this theory is saying is that essentially everything that's known about any stock or any bond, including where we are in the economy today and how that may impact these companies, the consensus of where everybody thinks the economy is going next, all of that information instantly gets priced into stocks and the bond market. And so the first component is that makes it impossible to predict which stocks to buy or sell, because that information instantly is reflected in the prices of these stocks. And then the second component, and there's only two that I'll talk about, is that if there is no predictability, then the only reason you would take more risk or buy a more volatile stock or buy a more volatile investment is because you felt that it is if you're having higher expected return from that investment. So it's easy to show you with bonds, for example. If you buy a government bond that's paying 4%, there's no way that, let's say, even a General Motors bond is going to pay 4%. It's going to have to pay 5 or 6% because people know that it's at least more risky than the U.S. government. So bonds almost automatically get priced by the bond market to where the higher the yield, the more the risk is. Similar things are happening with the stock market. So the important two components to remember in this theory is, one, there is no predictability because all of that is instantly baked in. And two, everything really does get priced to where it's about risk reward. The more risk you take, the more potential return you have. One example I always use is Amazon. So what this theory is saying is that nobody should be coming to you saying you should buy Amazon, it's such a great company, because the market already knows that it's such a great company and it's priced it at $1 trillion market valuation to reflect what a great company it is. But on the other hand, nobody should be coming to you and saying you should sell Amazon, its stock price is too high, because again, the market has priced Amazon given everything that's known. What the efficient markets hypothesis says is that given everything that's known about Amazon, about the markets, the economy today, where that's going to go in the future and how that will reflect in Amazon's earnings, instantly gets priced into Amazon's stock price. So the only way that we try to encourage clients to think about markets and investing is your risk horizon and your time frame based on your goals and objectives. So this is a 95-year chart of markets, and the next 95 years are not going to look like this necessarily, but let's talk about this. So if you had invested $1 in smaller company stocks over a 95-year period, it would have grown to over $56,000. If you had invested $1 in slightly more conservative, larger company stocks, more established companies, $1 would have grown to over $14,000. If you had left $1 in government bonds, it would have grown to about $177, so significantly lower amount over that period of time. And if you had left $1 in just cash or short-term instruments, it would have grown to somewhere between $15 to $20. So the idea is that the monies that you're not going to touch for 10 years or more ideally should be heavier in stocks and real estate. And the monies that you may need over the next 2, 3, 4, 5 years really should be heavier in cash and short-term instruments, because you could have, if you look at around 1929, you could have a 5-year period where you have a significant loss in the stock market. So ideally, you're not putting money that you need in the short run into the markets. So think about investing in terms of time frame, and let's completely forget about making predictions and picking stocks. Before we talk about that, let's talk about time frame and the risks historically of a diversified stock portfolio over varying points of time. So this is a chart of 1-year returns and 10-year returns of large cap stocks, going back also 95 years. So in the 1 year, you see this dotted line. You could be up 50%, down 50%. Lots of volatility in the markets over a 1-year period of time. The red line is the 10-year average annual return of this basket of stocks. In other words, if you look in December of 1959, if at that point for the preceding 10 years, you would have had a return of almost 20% a year. If you look around December of 44, over the preceding 10 years, you would have had a return of around 10% a year. What's notable about this chart is that it is very rare where over a 10-year period of time, you would have had a 0 or negative return. So it's happened, if you look at this chart, on 3 separate occasions, the latest one being in 2009, which was a negative 10-year period called the lost decade. But over every one of these periods, the subsequent period of time was an extreme bull market. So it has been historically very rare for a 10-year rolling period for someone to have lost money. So here's another way to look at historical sort of market ups and downs. Over 1-year periods, 26% of 1-year periods have been down. So 1 out of every 4 years in the markets has been a down year. But if you put your money in the market for 5 years at a time, 13% of the time, you would have lost money over a 5-year period. So even that does happen. Over a 15-year period of time, historically in the United States, there have been 0 occasions where you would have lost money over a 15-year period. That number turns in the US to 0 at 12 years. So there have not been any 12-year or longer periods of time in the US markets where you would have lost money over that period of time. However, that is not to say that that will never happen. We've had 20-year periods of time in Europe and Japan where people have not made money over a 20-year period of time. But I think the best way we can put it is, don't bet against the long-term trends that have happened for hundreds of years, that being that stocks and real estate in the long run tend to outperform bonds and cash. But at the same time, just because that's been the historical norm, don't put all your eggs into that basket. So don't necessarily think that it's 100% done deal that stocks are going to be up in 12, 15 years. The likelihood is that they will, but you do have to hedge against that. Getting back to the idea of market efficiency, we want to show you some statistics and data behind this. So first, we're going to talk about stock picking, and then we're going to talk about market timing. How have they fared historically? So to talk about stock picking, there's a lot of data that shows that stock picking does not give you a higher likelihood of outperformance. We'll just focus on one simple chart. And this is the performance of professional money managers, mutual fund managers, in all of the sort of major categories in the markets. There's a 20-year period ending in 2021. And we're looking at all the different major categories of investing and the professional fund managers in those categories who are trying to beat the index, which is a fixed basket of stocks meant to be representative of that category. So for example, in large caps, the large cap managers, these are professional money managers who pick large cap stocks, and their goal is to outperform the S&P 500, which is representative of the broad market, but it's really representative of 500 of the largest companies in the United States. And the goal of large cap managers is to beat the S&P. Over this 20-year period, only 5.88% of professional large cap managers beat the index that they were trying to beat. The same thing happens in mid cap. Only 8% beat the mid cap index. In small caps, only 6.5% beat the index. So if you look at this chart, in every category of investing in the public markets, professional money managers have substantially underperformed the index. So your next question might be, well, why don't we just buy the ones that have beaten the index? Well, the data, unfortunately, indicates that those roughly 10% on average that beat the index over one period of time did not have any higher of a likelihood of beating the index or even being in the top half of professional managers in their category over the next 10 years. So there was a study done that looked at large cap growth managers, and stay with me on this because this was done over multiple different categories as well over many different periods of time, where they looked at the performance of large cap growth managers. This is one specific category of investing, and looked at the top 25% of those managers, the second 25, third 25, and the fourth quartile, the worst performing 25% of those managers. How did they do in the next 5 years? Of the top quartile, more than half of them, 58% of them, ended up in the third and fourth quartile in the next 5 years. Of the worst performers, 62% of them ended up in the top two quartiles over the next 5 years. So in other words, the worst performers actually had a higher likelihood of ending up in the top half over the next 5 years. And this study has been done over multiple year periods of time to look at their subsequent performance. It has been done through large cap growth, large cap value, mid cap, small cap, all these different categories. And it found that actually picking the best performing manager of one period of time gave you no higher of a likelihood of performance over the next period of time. So you get back to the reason for this is because, again, the markets are very efficient. They priced in everything that these managers know, and the top performers over one period of time really are the ones that tended to have gotten luckier. We can conclude that if you buy the index and keep your costs low, you generally have a high likelihood of outperforming any individual professional stock picker. So we're going to move on from stock picking to market timing. Is it in your best interest to try to time the markets and say, this is a good time to get into the markets, this is a bad time to get into the markets? Our experience and the data suggests that that is actually potentially the worst activity you can do for your portfolio. So you hear people on the news, on TV, making these predictions. You hear the magazines making these predictions. Buy now, it's time to sell. How did these predictions really do, though? Is anybody following these and saying how, and to see how these predictions have done? There was a market timing study that was done that did just that. They studied 237 investment newsletters, and these are well-respected newsletters. Most of them people subscribe to get recommendations of it's a good time to buy in, it's a good time to go out of the markets. How did these recommendations do? So this study looked at 237 investment newsletters over a 13-year period of time and looked at over 15,000 asset allocation recommendations of when to go in and out of the markets, and found that the recommendations were not only useless, but potentially more harmful than just random recommendations. So this is further support for this. Every year, Wall Street's top strategists from all the major firms make predictions about where they think the market will end the year. How will the market do in the upcoming year? And this orange line is their prediction about where the market will go. The green line is actually where the market went. It had nothing to do with their predictions, and the predictions have proven to be far, far off. Same thing with interest rates. The Wall Street Journal has done a survey for the last 40 years, every 6 months when they go to a team of economists and say, is the interest rate on the 10-year treasury going to be higher or lower in the next 6 months? It is a 50-50 guess, and the economists were right a little better than 1/3 of a time on a 50-50 guess. And again, that's because markets are very efficient. The bond market has already priced in interest rate predictions, and that's why it makes it impossible to know where they're going to go next. Now we want to focus on investor behavior, common mistakes, and their effects on portfolio returns. This is a very well-known behavioral finance chart. The field of behavioral finance studies investor behavior and how investors tend to behave at different parts of the market cycles. And as you can see, as markets are going up, investors tend to have thrill, euphoria, and at the top of the market, it's where people generally are elated. At the bottom of the market, as it's going down, they have fear, panic, and at the point of maximum opportunity is generally where the typical investor is too afraid to be into the markets. The field of behavioral finance studies lots of different investor biases and how they could impact investor decisions. So we've split those into 3 different areas. The first are behaviors and biases that can lead to taking too much risk, ignoring asset allocation, and not being properly diversified. I'm not going to go through all of these biases. You have them in front of you, but the ones really to focus on are self-attribution bias. That is where we attribute the successful picks to ourselves, but the unsuccessful picks came from outside factors. So for example, you might have somebody that picks 10 different stocks over a period of time. One of them does great, the other 9 do horribly. And the one that did great, they're attributing to their stock picking prowess, but the 9 that didn't do well at all is because, there were these outside factors. Overconfidence bias, having extreme confidence in one's investment abilities, incorrectly rating oneself above average in selecting investments. And so these biases lead to investors becoming so sure of something that they end up taking too much risk, potentially being over-concentrated and buying just a few different things instead of being properly diversified and sticking to the principles of what works best. The second category of biases, and one to really be careful of, are behaviors and biases that can lead to tendencies to buy at highs of the market and sell at lows. These are things like recency, predicting future performance from the recent past, herd behavior, following others' investment strategies, or copying the behavior of others. So we're doing this in February of 2023 right now. If you look about a year ago where everybody was talking about crypto and feeling like they're missing out, that is herd behavior, where they're not looking at fundamentals. They're just looking at the fact that everyone's talking about this, so I should be in it. Or recency, thinking that, something's gone up, and to come out and say, it's going up. It's not going up, it's gone up. So you have to be careful of these types of tendencies. The last of these that we'll focus on, and this one and the next one will really show you the effect and the uselessness of these biases, is let's talk about the hot hand fallacy. This is perceiving that trends exist when none do. So an example is you flip a coin 10 times, all 10 come tails. The hot hand fallacy is the person that believes that the next one's gotta be tails because the last 10 were tails, right? That it's a trend. Well, the next one is still a 50-50 odds, assuming you have a normal coin, right? We get into the next category of behaviors. These are behaviors that can lead to inaction or freezing when action might be warranted. So we're going to start with the gambler's fallacy, which is really just the opposite of the hot hand fallacy. So this is erroneously believing that certain events are less likely to happen following a series of events. For example, same series of 10 coin flips, all come tails. The gambler's fallacy is the person that comes and says, well, the next one's got to be heads because it's too many tails. The hot hand fallacy and the gambler's fallacy, direct opposites, but it shows you the harm of having these biases when they're seeing the exact same thing and coming to completely different conclusions, neither of which is warranted. Other behaviors that can lead to inaction are things like loss aversion. That's expecting to find high returns with low risk. Sorry, but it doesn't work that way. You are not going to make 10% guaranteed in anything. In fact, you're not going to make anything guaranteed in anything. So always remember that everything has some risk to it. Confirmation bias is another one of these biases. And this is something that you see in regular day life as well, not just in investing. And that is a selective perception that emphasizes our beliefs, but devalues information that contradicts our beliefs. In other words, seeing what we want to see. We show these biases because it's important for investors to be cognizant of them in an effort to try to avoid allowing these biases to lead investment decisions. So in summary, on behaviors and biases, investor misconceptions can be dangerous to your investments, so they need to be identified early and countered in an appropriate manner, and markets and investing must be viewed in a rational and productive manner. So now we come to the most important slide in this presentation. And I'm going to use 1991 till 2010 to illustrate this, but I'm going to show you more recent numbers in a second. From 1991 till 2010, there were a lot of down years, a lot of rough years. 1994, the Fed was raising rates multiple times. Markets were down. 1998 was a Russian fiscal crisis. Markets had a rough year. 2000, 2001, 2002, that's 3 years of the tech bubble bursting. And then the 08-09 financial crisis. So there were a lot of volatile years during this 20-year period. If you had held the average stock fund for that entire 20-year period and never paid attention to the news, never made any changes to your portfolio, the average investor in the average stock fund would have had a return of 9.9% per year net of fees for that 20-year period. But the investors in these stock funds only captured 3.8% out of that 9.9%. And that came strictly from their behaviors. In other words, if they had just held on for that entire 20-year period, they would have made about 9.9% a year. That's making almost 8 times your money during that 20-year period of time. But they captured only a fraction of that return. Why is that? Now, this gap between that 3.8% and the 9.9% is called the investor behavior gap in behavioral finance. It actually has a name because it's an actual thing that exists over every period of time that we can look at. So what ends up happening is investors who follow the news to drive their investment decisions tend to want to buy when the news is great, and they want to sell when the news is bad. And when we say the market's very efficient and it prices in all the available information, when there is great news in the economy, the market's very high to reflect all the great news. When there's bad news, the market's very low to reflect all the bad news. So I'm sure you've heard the saying, buy low, sell high. The average investor tends to want to buy high on good news and sell low on bad news, thereby destroying their potential long-term returns. We want to educate you to not pay attention to what is going on in the news to drive your investment decisions. So we've talked about what not to do. We'll talk in a second about then what do you do if there's no predictability. And these are more recent numbers. So this compares the average equity investor, average investor in the markets to the S&P 500 and the average fixed income investor to the bond market, and finds that the averages are substantially underperforming these indexes because they're not buying and holding. They're making big changes based on the news. So to illustrate this, we want to talk about a study that was done in 1991 by psychologist Paul Andresen at Harvard University, where they took 2 groups of investors and studied them over a period of time. They both got to pick their own stocks. One group got just price updates on their stocks, whereas the other group got price updates and constant news and information on their stocks. The group that did not get news and information did twice as well as the group that got information. I would argue that the reason for this is when you're only getting price, stock goes up, you sell, stock comes down, you buy. When you're getting information, good news comes out, stock is up and they're buying. bad news comes out, the stock is down and they may be selling. So there's actually a lot of data that shows that following the news is actually not helpful to long-term investment decisions. So this is another chart that illustrates how your emotions can have a negative impact on your long-term returns. So this is a study of the Consumer Sentiment Index and the subsequent 12-month returns of the market. And so you could see when the sentiment was down at the bottom, February 1975, market was up 22% over the next 12 months. 1980, market was up 20%. October 1990, the market was up 29%. So in all of these situations, when sentiment was at its worst, over the next 12 months, the market did great. Now, what about when confidence was at its high? August of 1972, next 12 months, negative 6%. March of 1977, next 12 months, positive 1%. The top left of this chart shows you at the 8 sentiment peaks, the subsequent returns were 4.1% a year on average. At the troughs, at the lows in sentiment, the market was up almost 25% over that period of time, over the next 12 months. So if you're going to be invested in the markets longer term and stay the course for your long-term money, rather than trying to get in and out of the markets, what should you expect? So from 1952 till December of 2021, on average, there was a drop of 5% or more from a new market high, about 3 times per year. It's a very regular part of the cycle. A drop of 10% or more, that the news calls a correction, happens on average once a year. A drop of 20% or more has been happening on average once every 6 years. So you should expect that you will have drops in your portfolio. But again, the overwhelming amount of data shows that you are better off staying the course rather than trying to time when the next bad event is going to be, because 10 years, 15 years, 20 years down the line, with all of its ups and downs, the likelihood is that the markets will be much higher. There is a reason every year and every day to be afraid. There is a crisis going on in the world every single year. This is a list of all the crises that have been going on from 1975 till 2020. We can go back even further. There will not be a year that is missing a crisis. So now we talked about what not to do. Now we're going to talk about what to do, and we're going to talk about asset allocation. So there was a landmark study that was done in 1991 that concluded that asset allocation explained the majority of the variation of portfolio returns. That very little had to do with security selection, that's stock picking, or market timing. So what we mean by this is the most important decision that you can make for your portfolio based on your risk tolerance, your time horizon, and your goals and objectives, and those matter more than anything else, is what percentage of your assets should be invested in these 5 broad categories. And those are stocks or equities, bonds or fixed income, real estate, cash, and ultra short-term fixed income, or alternative investments or other, which is kind of a broad category of investments that don't tend to move as much with stocks and bonds and real estate. So that's things like private equity, private debt, private investments, commodities, lower correlated assets. The most important decision that you can make is what percentage of your overall assets should go into these 5 categories. The next decision is, within each of these categories, what are the sub-asset classes that we should invest in? So within stocks, we tend to see a lot of stock portfolios that come to us that are invested heavily in U.S. large cap stocks, because those are just the names people have heard of. But in fact, small caps over long periods of time have tended to outperform. You need to have diversification internationally. So within stocks, how much should you have in large cap stocks, small cap stocks, mid cap stocks, international stocks, emerging market stocks? And then the third decision is, what do you buy for large cap growth? What do you buy for large cap value, for example? So you could buy a basket of large cap stocks, which we recommend for most investors not to do, because you don't need to take that risk of those individual stocks. You could buy a mutual fund and give your money to a manager to pick stocks for you. For the reasons we mentioned before, we recommend against that. Or you can buy the index, which is what we recommend, for that category. So a large cap growth index or a low cost way to purchase these different categories. But it's a multi-step process. It should not start with, I like this company, so I'm going to put all my money in it. It starts with a plan, and that is based on your goals and objectives, and those answers need to be different for everybody. So when we talk about diversification, you could be in a portfolio of 20 stocks that all are similar, and you're not really going to be that diversified. The way to diversify is you want to diversify across the asset classes that we talked about, the categories. Then you want to diversify geographically in the United States and internationally. You want to diversify through capitalizations, have small cap, mid cap, and large cap. You also want to diversify between styles of investing, growth and value. And what those are is growth stocks are companies that generally are growing faster. They're putting the money back into the company to continue to grow. They tend to trade at a higher multiple. Value stocks are companies that may pay a dividend. They trade at a lower multiple and are considered to have more value. So why is it important to have diversification in all of these ways? So let's look at US versus foreign stocks. If you look at this chart, the purple shows international stocks, periods of time when international stocks outperform the US. The gray shows the periods of time when the US outperform international. And just as we always say, investors tend to want to buy high, right? You have people that will look at the last 15 years and say, why would I want to diversify internationally? The US has done so much better. Well, that doesn't mean that it always will. So if you look at this, there are long cycles when one does better than the other. If you own both, you are protecting yourself from that extra volatility and that extra risk. Same thing with growth and value. The light green is growth. The dark green is value. You have multiple years when one does better than the other. In the long run, value has tended to outperform, but we do recommend having an allocation with both, potentially with a little bit of a tilt towards value. Now, this is what I think is the second most important slide in this presentation. So this is a risk-reward chart. And ideally, we always say with this chart, you want to go up and to the left when you can. Things don't really work that way, but you want to ideally go up to get higher returns and left to have lower volatility or risk. So on the bottom right in the orange, this is a 100% bond portfolio. If you had added about 1/3 in stocks to that portfolio, so now you're adding something that is more volatile and more risky, you would have kicked up your returns because stocks have done better than bonds over almost every long period of time. But what surprises a lot of people is even though you added a more volatile, more aggressive investment, you actually reduced the overall volatility of your portfolio. So why is that? How could you take something that's more aggressive and actually reduce your volatility? And the reason is correlation. These bonds are all moving up and down together, primarily with interest rate movements. Stocks move differently. So if you add a component in stock to this all bond portfolio, you will actually end up with a portfolio that has slightly lower volatility. Now, this up and to the left doesn't always continue to happen. Ultimately, it really is the more risk you take, the more return potential you have. But the idea is that true diversification, when you're diversified across asset classes, and when you're diversified within those asset classes into different types of stocks and different types of bonds, you can gain either higher returns for a similar level of risk or lower risk for a similar level of return. That's the beauty of asset allocation done right. This chart also will tell you why even the most conservative investors, meaning people who are putting money away for the long run, money that they're not going to tap into for a period of time. So this will show you why even the most conservative investors should have some stocks, but also it'll show you why even the most aggressive investors should have some bonds. Because look at the other side of this. This purple is the all stock portfolio. If you had added 20% in bonds to it, you would have reduced your risk substantially, but not taken too much away from your returns. So in conclusion, what is our process that we suggest for clients? Well, the Aire 7-step process really starts with understanding the client. And we want to understand what your goals are. What is it you're trying to accomplish? In many cases, it's when do you want to retire? How much do you think you're going to need to live on per year when you retire? And then get comprehensive discovery understand all about you. And then we go back and create your financial plan. And your financial plan, the goal of it is to look at all of the assets and say, okay, here's how you're currently invested. What does your asset allocation look like? Because most of the time when people come to us, we tend to see that they're very heavily concentrated in just one or two areas versus what might our recommendation be. And then the second and more important part of it is, are you on track to reach your goals? And if so, how much could you spend upon retirement? How much does it look like you can spend? Or if you are retired, how much should be your max budget for the upcoming 12 months to stay in the safe zone? That's what investing really is all about. It's not about following the news and listening to what all the hot stories are today, because most of the time that's where the biggest danger lies. It's really about understanding your goals and objectives. What are you trying to accomplish? Creating a financial plan and sticking to the guiding principles of your well thought out plan. And each year, you should have a full annual review done where you have a fully updated plan that is a forward-looking document to look at where are you today versus your goals and objectives, and consistently monitor this. Now, a couple of other notes. So when we invest in lower cost ETFs, we're not just necessarily holding forever. We do monitor, we do look at tax loss harvesting. So if there's a year like 2022 when the markets are down, you can sell one ETF, buy a similar one or a high correlated one that's not in the same index, book the loss on the one that's down, and retain 100% market exposure. That is a powerful strategy that will save you a lot in taxes in future years. We also spend a 2-month period every year where we comprehensively review all of our asset classes and all of our choices for those asset classes to really think about, is that still the best choice? Or is there other data that suggests that we should do something slightly different? But the tax management of your investments is key. To minimize how much you're paying out in taxes is a key part of your long-term returns. But we do also rebalance each year. So we try not to kick off taxes. We can rebalance using retirement assets and just make sure that your overall assets are properly diversified. But it is important to look at that, because if you look at this chart, just going from 2001 till 2021, so over a 20-year period, if you never rebalance your stock allocation from a 50-50 allocation, because stocks have tended to do better than bonds in the long run, has grown to the majority of your portfolio, right? So it's 20 years has gone by when most people over that period should probably be getting more conservative. But if you don't rebalance your portfolio, it's getting more and more aggressive over time. So it is important to monitor where you are in your investment balance, and that's part of that annual review process. But it's not about making those predictions that can really be detrimental to your financial health in the long run. So to summarize, the publicly traded markets are very efficient and instantly price in all news and information. The most important decision is to determine what broad mix of assets you should invest in. The next most important decision is what underlying sub-asset classes you should invest in. And then the last decision should be, what should you buy for each of those asset classes? And while still important, that last decision is not nearly as important as that first decision of how much should you invest in the broad categories. These decisions have to be made differently for each individual, but all investors should have a certain percentage of money, vastly different from one another, in stocks, bonds, cash, and alternatives. That means that even conservative investors should have some stocks and real estate. Even aggressive investors should have some bonds and cash. The next point is, do not allow the news and the ups and downs of the market to deter you from the unemotional asset allocation model that you have in place. Remember that slide that we talked about on investor returns versus the people who just held on. Do not try and predict the direction of the market or pick stocks based solely on predictions. These activities are not worth the risk-reward trade-off, and timing the market has proven to be counterproductive. So do not ask, what should I be doing now? Or what do you think the market will do next? Or what stock should I buy? The answer is to build a broad, diversified portfolio that takes your goals and your time horizon into account. And your focus should be more on how the assets work together than on the past performance of each component. The portfolio should be rebalanced periodically, taking taxes into account, in order to prevent the asset allocation model from falling out of place. And also remember our ultimate lesson here. While stocks and real estate have historically provided strong returns over almost all 10-year periods, there is no assurance that that will always be the case. However, betting against these asset classes in the long run is generally not a good idea. But betting everything on them is not either. It's important to diversify in case of seismic shifts in markets and to reduce volatility under normal circumstances. And to highlight the benefits of investing by planning rather than predicting. First, you will have a knowledge of each component in your portfolio and the reason why that's in your portfolio. And you're investing based upon time frame and risk. It's going to be more tax efficient. It's going to be lower cost. You avoid rash decisions. Decisions are more clear. You generally tend to have a higher probability of getting better returns with lower risk. And your focus will end up being on the plan rather than on what the market is doing every day, which is something that can drive anybody crazy. We hope you found this to be helpful and enlightening. For more information, please feel free to take a look at our website at www.aireadvisors.com. Thank you and happy investing.